Welcome to the Vaughan Nelson podcast. Today is the fourth quarter 2025 Vaughan Nelson Value Opportunity Recap. And with me today is lead senior portfolio manager, Dennis Alff. And with that, Dennis, I will turn things over to you.
Great. Thanks, Dan. Before we get started, just want to wish everybody a happy new year to everybody that's out there. We here at Von Nelson just want to wish everybody a happy and healthy 2026. Let's get to the portfolio. The portfolio had another solid, if not spectacular, quarter, which contributed to a positive year of outperformance for 2025. It was another strong quarter where stock selection drove the great majority of our overall return and where we saw broad participation with our top 10 performers coming from multiple sectors, which is something that we always very much like to see. On a more granular level, the portfolio experienced very strong absolute and relative performance in the technology sector. Here, the portfolio's exposure to companies levered to the growing data center and AI revolutions continue to post excellent fundamental results and rewarded stock prices. The portfolio's significant underweight to software-oriented companies was a significant relative help as well, as many of these companies performed poorly in the quarter. The team has a very negative view of most software stocks, as we view this group as facing material headwinds in a world where AI grows and offers competitive threats. Strong stock selection and energy in the financial sectors helped the portfolio with positive contribution as well. The portfolio has a long-standing position in an offshore energy services company that has invested very heavily over the years in creating best-in-class products that continue to gain share in the market. In financials, the portfolio's position in a major credit card provider performed very well as credit losses continue to be benign and the consumer shows resilient strength. Also, the portfolio recently added a leading mortgage consolidator, which performed very well in the quarter as the Fed continued to cut rates, which created some optimism for lower mortgages in the future for consumers. Interestingly, despite those Fed rate cuts, the bond proxy business models like utilities performed poorly and hurt the portfolio given our material overweight to that sector. Fortunately, our significant underweight to the REIT sector, where we see very little fundamentally to get excited about, performed poorly as well and offset those relative losses. However, there was no offset for the portfolio's underweight to the healthcare space, which posted very strong returns and created a negative relative performance for the portfolio. Healthcare, and more specifically, pharma and biotech companies, rallied substantially in the quarter after several major drug companies struck a deal with the Trump administration to lower prices on some drugs in exchange for tariff relief. The team agrees that this is an important development for the healthcare sector and healthcare companies and is working very hard to find opportunities in that space to add to the portfolio going forward. Now that we're at the end of the year, I think it's always interesting to look back and see how things have changed. While the strategy had great performance in multiple areas, perhaps the biggest thematic driver of performance in 2025 was the portfolio's exposure to AI and data centers. While the team believes these companies will continue to post strong fundamentals going forward, valuations have become very stretched, making strong equity returns more difficult to see. The result is that we've trimmed many of these positions, and the portfolio's weighting in this end market is down considerably, and today only represents a little more than 9% of the overall portfolio. In its place, the portfolio has seen a major increase in companies exposed to power markets, where we have seen a growing disconnect between supply and demand. These companies loosely comprise around 23% of the portfolio today, which is a material increase from a year ago. Similarly, the team feels strongly that a broadening economic expansion is beginning in the economy. As a result, the portfolio's exposure to companies referred to as early cycle, or simply business models that are quick to see improving fundamentals, is just over 30% and is evenly split between consumer and industrial companies. Finally, the remaining 35-40% of the portfolio is focused on truly unique and idiosyncratic opportunities. I guess the takeaway from looking at this is that the team has done a great job of harvesting winners from 2025 and redeployed that capital into opportunities where we believe fundamentals are starting to positively inflect and are at much better valuations today. We feel these changes are the right changes for the portfolio. We see an improving economic backdrop given the tailwinds of lower rates and fiscal stimulus from the One Big Beautiful Bill, among a few other factors. We are excited for 2026, and we are looking forward to having another really strong year. With that, let's wrap it up there, Dan, and I'll turn it back over to you.
Okay, great. Well, thank you, Dennis. And we will start to move into returns here. In the fourth quarter of 2025, the Von Nelson Value Opportunity Strategy returned 2.11% gross, 1.89% net, and the Russell Midcap Value is at 1.42%. Over the full year of 2025, the Von Nelson Value Opportunity returned 13.25 gross, 12.3 net, and 11.05 for the Russell Midcap Value Index. Over the past 3 years, the Von Nelson Value Opportunities returned 16.8% gross, 15.82% net, and the Russell Midcap Value is at 12.27%. Over 5 years, 12.08 gross for the Von Nelson Value Opportunity Strategy, 11.14 net, and the Russell Midcap Value Index is at 9.83%. And last, over the course of the past 10 years, the Von Nelson Value Opportunity Strategies returned 10.54% gross, 9.6% net, and the Russell Midcap Value Index is at 9.78%. And with that, Dennis, that's a wrap on the fourth quarter. It's a wrap on 2025. So thank you very much, and we'll have you back soon.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.